So let's move on now to talk a little bit about carbon pricing and emission trading systems. So let's move on now to talk a little bit about carbon pricing and emission trading systems. As we go through, please send in your questions. We had a lot of questions before the webinar started today. I've got a printout of them here, and we'll be going through them. But please send additional questions as we continue. So we live in a market-based economy. In this economy, broadly speaking, it's an economy dominated by supply, demand, and price. These are the main things that cause big levers to move in our economy. And as Jim Yong Kim, the former president of the World Bank, says, there has never been a global movement to put a price on carbon at this level and with this degree of unison. By placing a price on carbon emissions that reflect the cost, the damage they impact our society with, it provides a disincentive and an incentive for companies to find low carbon options to manufacture their product. And so this is a key lever in a market-based economy in which we live. We must put a price on carbon. Today, if you build a factory, you build your product, you emit carbon dioxide. In many countries, those emissions are not priced. It doesn't cost you anything. You can pollute for free. But as we've seen, those emissions do have a direct economic cost. And therefore, there's now this movement to put a price on carbon emissions. The World Bank has produced this. There are two ways to price carbon emissions. One way is to tax carbon emissions, and the other way is a cap and trade system where emissions are capped and the underlying companies can trade the carbon. You can see the yellow bar on the graph here. That is China. China is launching later this year, Corona notwithstanding, the largest emission trading system in the world, covering 3.3 billion tons of carbon dioxide. And when that comes on stream, you can see on the left, on the y-axis, approximately 20% of emissions on the planet will be covered by some type of carbon price, either a carbon tax or a cap and trade. Now, when we talk about carbon markets, there's a lot of confusion. And I want to try and clear this up because many people confuse the different carbon markets. The first thing is to say is that there are three distinct and separate carbon markets. The first is the compliance carbon market, which I'm going to deal with separately in detail because that is the market in which we invest. It is highly liquid, highly regulated, and very large in size, trades 1 billion per day. But I want to provide some information about the other carbon markets because often investors get confused between these different carbon markets. So on the far right is what we call the voluntary carbon market. This is what most people are familiar with carbon. This is where you buy a carbon offset by investing in a project, normally in a third world country for perhaps planting trees. It might be for clean cook stoves, where a project developer will calculate the potential carbon emissions reductions from the project. That will be approved, and then they will develop the project and they will sell those carbon offsets. That market has some very well-meaning people. It is growing because more corporates want to offset their carbon footprint through investing in these projects. And many of the projects have very good co-benefits. For instance, they will often not only plant the trees, but build a school for the children in the nearby village, provide sanitation, etc. These kind of excellent co-benefits. That market, however, is quite small, perhaps about $300 million a year. It is growing, though. It is largely unregulated, and there is no liquidity. When we think in financial terms of liquid markets, this market has no liquidity. So that is the voluntary market. The middle market is the international carbon market, or we sometimes call that the United Nations carbon market. Under Article 6 of the United Nations Framework Convention on Climate Change, a mechanism was developed to allow countries to invest in carbon mitigation projects that would help them meet their commitments under the Paris Agreement. Now, that carbon market, that boomed during 2005, really until the financial crisis in 2008. And since then, that market has really been in abeyance. It's kind of in suspended animation today, although at the next annual conference of the parties, which is the large annual conference of United Nations representatives, they are hoping to reinvigorate that market and engage it so that countries can begin investing in projects to meet their commitments under Paris. But that market is currently, let's call it, frozen or slightly in abeyance. And then, as I mentioned, you've got on the far left the compliance carbon market. This is a highly regulated market. It's the cap and trade market that certainly that we deal in. It's very large, trades $1 billion a day. There are exchange listed derivatives, futures, and options on the market. And it's very, very highly regulated. I'm going to talk a little bit more about that now. So how does an emission trading system work? It is a market-based policy, and the objective of the policy is to cap and lower emissions. So I'll just take you through the economics of a cap and trade system, and hopefully it will make sense. The objective is to reduce emissions at the lowest cost to society. So in a carbon market, like in Europe or the California market, any entity that has emissions above a threshold is automatically included in that market. You don't have a choice, it's law. So we call that mandatory. It's mandatory participation. The total emissions in that market are capped, and carbon allowances, the certificates, are allocated and auctioned to the underlying companies. And typically these are the big emitters in the economy. So for instance, in Europe, we have about 13,000 entities in the cap and trade system, and they cover about 50% of the total emissions in Europe. Each allowance permit allows the emitter to emit 1 ton of CO2, and those entities that are participants are very tightly audited every year. They must submit certificates every year in the year following the emissions year after the audit. If they emit 1 million tons, they must submit 1 million allowance certificates. If they do not, they are fined. And in Europe, the fine is 100 euros per ton. And of course, the current price in Europe is about 20 euros per ton. So all these entities do comply. The other interesting thing about a cap and trade market is the trading side. The entities trade the allowance with each other. And as I mentioned, Europe is a very liquid market, trades 200 or 300, 400 million US dollars per day between futures, options, and physical carbon. And by trading the carbon between them, that sets a market price. So one of the things that an emission trading system has that we like is it is a market-based mechanism rather than a diktat, a fiat diktat of a carbon tax. Every year, the total supply of carbon is capped, and that cap is lowered every year in most markets by about between 2 and 3% a year. So this gives us the first good thing, which is environmental certainty. It means we know emissions must come down because the total emissions in the region are capped, and every year the cap is reduced. And the elegant part of an emission trading system is that because the underlying entities trade the carbon with each other, different companies will have a different abatement cost. In other words, they'll have a different cost of carbon at which it makes sense for them to look at a low carbon option. And therefore, by removing the supply every year, it means someone in the system must abate, they must reduce emissions or stop emitting. And the trading means that the invisible hand of Adam Smith allocates those permits in a way that the reductions are achieved at the lowest cost to society. This is a very, very important benefit of an emissions trading system. The final thing is that when you have a liquid price on carbon, it fosters a huge amount of innovation because it provides a pathway to monetization for entrepreneurs, for scientists who can figure out ways to decarbonize our economies. They are motivated to do that because there's a large financial incentive to do that, because there's a liquid carbon price, so they can monetize the development of a technology. And this is perhaps one of the most interesting things of why a market-based solution to climate change, like cap and trade, has been successful and is now spreading around the world. And this schematic sort of illustrates that. The dotted yellow line is the cap, and that cap comes down every year while the underlying entities can trade the emissions between them. So we achieve the environmental certainty. We know that emissions have to fall. They must fall. And we have a high degree of confidence that that's being done at the lowest cost to society. Now, in Europe, it's the longest running emission trading system. It was implemented in 2005, and emissions have dropped by 1 billion tons per annum since 2005, not only because of the emission trading system, low gas prices, technological developments, regulation. There have been many factors in lowering emissions, but in a market-based economy, a liquid carbon price sends a strong signal to participants about what is happening, where is policy going, and that has been a big driver of the reductions. And in particular, since the European carbon price has gone up in the last 2 years, because when you burn coal as a utility, you emit twice the carbon dioxide you do burning gas. Gas is a cleaner burning fuel. It means that coal has become economically not competitive in Europe. The higher the carbon price, the lower the competitiveness of burning dirty coal in particular. And we have seen that in Europe now. And of course, one of the big benefits of knocking coal off the stack is the particulate emissions that are particularly damaging for children and anyone actually breathing, over and above the impact on greenhouse gas emissions. So if we look at the track record, and one of the things when we talk about climate change is we want to move the needle. We want to impact climate change on a scale of hundreds of millions of tons, not 1 million tons. 1 million is a lot of carbon dioxide. But if we want to attack the problem, the policy of cap and trade can move the needle at scale. And indeed it has. So in Europe, emissions are down 29% and GDP is up. In RGGI is the Regional Greenhouse Gas Initiative. It consists of 10 US states on the east coast of the United States. Been very successful at reducing emissions while GDP has gone up. And finally, California, the most recent liquid carbon market, down 10% in emissions while GDP has climbed. Korea has relaunched its carbon market, covering over 500 million tons in 2018. And currently, emissions trading system cover 8% of emissions, 37% of GDP from those countries. And because a big portion of the carbon certificates are auctioned, they've raised $57 billion in proceeds. Most of those auction proceeds from auctioning carbon to the emitters are invested in low carbon and green initiatives. So there's an additional benefit with an emission trading system. The big news, of course, is China. Now we've got the coronavirus, so none of us know the impact on the delays, but thus far China has said they're sticking to their schedule. They've been running 8 pilot emission trading systems now for the past 6 years, and they're launching later this year a national emission trading system covering 3.3 billion tons of emissions. New countries are also in the frame: Mexico, Indonesia, the Philippines, Colombia, the Ukraine. In the US, Virginia State, Washington State, Oregon State, all are looking to either launch or join an existing emission trading system. So it's very interesting that this is spreading and becoming a global phenomenon, because I think by and large it's been successful. Because we live in market-based economies, people don't like a carbon tax. They prefer a market-based mechanism.